Welcome to our Foundations module on the stock market. By the end of this scene, you will be able to define what the stock market is and distinguish between primary and secondary markets. Let's start with a simple question. What is the stock market? At its core, it is a place where ownership in companies is bought and sold. In India, this happens primarily on two major exchanges, the National Stock Exchange, or NSE, and the Bombay Stock Exchange, or BSE. Think of these as the giant digital malls where the trading happens. Now, there are two stages to this market. First, the primary market. This is where a company sells its shares to the public for the very first time through an initial public offering, or IPO. At this stage, the money goes directly from the investors to the company to help it grow. Once those shares are listed on the exchange, they enter the secondary market. This is what we usually mean when we talk about the stock market. Here, investors buy and sell shares from each other. If you buy a share of Reliance today, you aren't buying it from the company, you're buying it from another investor who wants to sell. So, the NSE and BSE act as the facilitators, ensuring that when you want to buy, there is a platform to find a seller, and vice versa. In this scene, we will explore why stock prices fluctuate and understand what a market index actually represents. You often hear people say, the market decided the price. But the market isn't a sentient being. Prices move because of a very specific buyer and seller mechanism. Imagine a stock is trading at 100 rupees. If more people want to buy the stock than there are people willing to sell it, buyers will start offering 101, then 102, just to convince someone to sell to them. This pushes the price up. Conversely, if everyone wants to sell and there are no buyers, sellers will drop their price to 99, then 98 to attract a buyer. This pushes the price down. It is a constant tug-of-war of supply and demand. Now, how do we track how the overall market is doing? We use an index. The most famous one in India is the Nifty 50. A common misconception is that the Nifty 50 is a single stock you can buy. It's not. It is a basket, or a mathematical average, of the 50 largest and most liquid companies on the NSE. When you hear the Nifty is up today, it means that on average the value of these 50 companies has increased. It serves as a barometer for the health of the entire Indian economy. In this scene, you will learn the practical steps of setting up your trading environment and the difference between a Demat and a trading account. To participate in the market, you need two specific accounts that work together. First is the Demat account, short for dematerialized. This is like a digital locker. It does not hold cash, it holds your shares and securities in electronic form. When you buy a stock, it sits here safely. Second is the trading account. This is the interface provided by your broker that allows you to actually place buy and sell orders. Think of the trading account as the action layer and the Demat account as the storage layer. To open these, you will need to complete a KYC process, which stands for Know Your Customer. This usually requires your PAN card, Aadhaar card for identity verification, and a bank statement. Now, let us talk about where you open these accounts. The broker. There are two main types. Full-service brokers provide research and advice but charge higher fees. Discount brokers, like Dhan, provide the technology and platform for you to trade at a much lower cost. However, be aware that the broker's fee is not the only cost. Every time you trade, there are government-mandated charges like Securities Transaction Tax, or STT, GST, stamp duty, and DP charges for moving shares out of your locker. Always check your contract note to see the breakdown of these costs. In this scene, we will explore the difference between the cash market and the derivatives market, and introduce the concepts of futures and options. So far, we have discussed buying shares. This is known as the cash market or the equity market. When you buy in the cash market, you are buying actual ownership in a company. If you buy one share, you own that piece of the company forever, or until you sell it. But there is another world called the derivatives market. A derivative is a contract that derives its value from an underlying asset, like a stock or an index. You aren't buying the company. You are trading a contract based on its price movement. Originally, derivatives were created for hedging, which is like insurance. For example, a farmer might use a contract to lock in a price for his crops months in advance to protect against a price drop. Today, however, many people use them for speculation. The two main types of derivatives are futures and options. Here is the one-line distinction. In a future, you have an obligation to fulfill the contract at a future date. In an option, you have the right, but not the legal obligation to buy or sell. One major difference in derivatives is the lot size. In the cash market, you can buy just one share. In derivatives, you must trade in lots. For example, if a stock has a lot size of 500, you cannot buy 10. You must buy the whole bundle of 500. This is why derivatives require more care and capital. To summarize, in the cash market, you can buy one share. In the derivatives market, you trade one lot, which is a bundle of 500 shares. In this scene, we will learn how to read the primary tool of a trader, the candlestick chart. To understand price action, we use candlesticks. Each candle tells a story of what happened during a specific period. A candlestick consists of a body and wicks or shadows. The body shows the range between the open and the close. If the close is higher than the open, the candle is usually green. If the price closed lower than it opened, the candle is red. The thin lines at the top and bottom are the wicks, representing the highest and lowest prices reached during that time. Speaking of time, you can set your chart to different time frames. If you are trading options, the 5-minute or 15-minute charts are crucial for timing. If you are investing for years, the daily or weekly charts matter more. Finally, we look for support and resistance. Support is the floor where buyers usually step in to stop the price from falling. Resistance is the ceiling where sellers usually step in to stop the price from rising. Always look at volume at the bottom of your chart. High volume during a price move acts as a confirming signal, suggesting the move is strong and likely to continue. Mastering these tools is the first step toward successful trading. In this final scene, we will review a crucial summary of everything we have covered today. Please take a look at the information on the screen, as it serves as a perfect roadmap for your journey into the foundations of the stock market. Let's read through this together to solidify our understanding. Under the first point, what is the stock market? We discussed the primary versus secondary market and what the NSE and BSE actually do. We looked at how a company listing works in a brief, non-technical way, and why stock prices move driven by the buyer and seller mechanism, rather than just the market deciding. We also covered the index concept, explaining why the Nifty 50 is a basket of 50 stocks and not a single thing you buy. Next, for Demat and trading accounts, we clarified the difference between a Demat account, which holds your shares, and a trading account, which executes your orders. We listed the documents needed and the KYC process. We also differentiated between brokerage types, such as discount versus full-service brokers, and highlighted the charges to watch out for, including brokerage, STT, GST, stamp duty, and DP charges. Moving to cash market versus derivatives, we learned that the cash market involves buying actual shares, while derivatives are contracts based on price movement. We touched on why derivatives exist, starting from their hedging origins before becoming tools for speculation. We defined the one-line distinction between futures and options as obligation versus right, and introduced the concept of lot sizes. Finally, we looked at reading Nifty and Bank Nifty charts. We broke down candlestick anatomy, including the open, high, low, close, wick, and body. We discussed time frames, such as 5-minute versus daily versus weekly, and which ones matter for options. We finished with support and resistance basics and the importance of volume as a confirming signal. You have now completed the Foundations module. You are ready to move forward with a clear understanding of how the market functions.